Welcome to SB Talks. I am joined, as ever, by our trusty Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
Now, Nick is going to do his best to give us a quick flavor of what's in his 2026 Investment Outlook report. Time to go grab a quick cup of tea, settle in, because it's a good one. Thank you to all our listeners. Like any good 2026 outlook, we'll start in 2025. Quick recap on the year gone. What played out to expectations and what potentially surprised you over the past 12 months?
I think there's sort of at a high level, it sort of played out as we thought, that growth would continue to be fairly resilient, that there wouldn't be any kind of recession, that the sort of broad settings of sort of improving consumer spending power as inflation comes down, interest rates come down, things like that. That's largely played out as we expected. So according to the International Monetary Fund, they're forecasting growth this year of about 3.2%. That's broadly in line with sort of long-term trend rates, similar to the growth rate in 2024. So that, at a high level, played out as we expected. There were some regional differences, so we were maybe a little too optimistic on the strength of the US economy. We thought that the new Trump administration would do what they did in the first Trump administration, which was to really kind of cut taxes, create sort of more growth-boosting strategies.
Lead with the deregulation strategies from the front.
That's right. And what turned out was, in fact, they led with the tariffs, the more damaging strategies. So the sequencing was different. So we got that wrong. We thought growth in the US this year would be around 2.7%, similar to kind of where it was the prior year. It looks like it'll come in about 2%. That's still not bad for the US. It's a bit above trend, but it's not, it's not as strong as we thought it would be. And I think
probably in the early half of the year, halfway through the year, we really had no idea where it was going to end up in terms of the growth rate. But things at least have settled down and provided some more clarity, as much as you get with this administration.
Oh, absolutely. I mean, you just think about how disruptive those Liberation Day tariffs were. They really caught everyone by surprise. People thought, maybe there would be, some modest sort of universal tariff, and they, maybe he would go after China, but he, took on the whole world basically.
That big, beautiful board that he had out in front of the White House.
That's right.
Everybody's trying to figure out, how did you come up with these numbers?
So once we saw that, we thought, okay, those growth estimates are not looking too flash at the moment. So we got that wrong. But interestingly, we were too conservative on Europe. Europe's actually had a pretty good year. They've been fairly resilient despite all that trade noise. I mean, they did do a trade deal with the US, so that probably helped settle things down a little bit. But we still have conflict ongoing in Europe as well, which was seen to be a headwind for them. Well, the changing national security picture, I know we'll come to. It's a headwind, but it's also been one of the reasons why they've done a little bit better, and that's because we saw Germany really lift the debt brake. So that allows them to really spend and borrow a lot more than they have, really on defence and related infrastructure. So that's part of the reason why the Eurozone's done better this year than we expected. And partly that's due to the Ukraine conflict. So there's some regional differences. On China, we were probably a little too cautious. Their economy's actually been far more resilient than we would have thought, given the US-China trade tensions. So they're going to grow roughly 5% this year. We're a touch under that. And Australia is roughly sort of where we expected. I think one of the things that we did get wrong is that we thought that the disinflation story would continue.
We did. I do recall 12 months ago, the transitory conversation was very much at play, and we thought maybe Team Transitory had it, but it's crept back.
Yeah, so, I mean, we thought inflation would continue to come down, and that hasn't been the case. Obviously, tariffs are part of that story. They've been inflationary in the US. But I think also just, the economy's been probably a little bit more resilient. Unemployment stayed pretty low. That return of consumer spending powers just created a bit more inflationary pressure. So in a lot of countries, inflation's actually gone sideways, maybe even a little bit up. as we've seen in Australia recently. So, for example, we thought Australia inflation would come down to 2.7, trimmed mean, which it did mid-year, but then it started going back up again. So we were a bit wrong there.
And that obviously is a natural flow through to the outlook for interest rates as well.
Yeah. I think in terms of some of the other big calls we made, I mean, we talked about, the second Trump presidency being one of some, he thrives on uncertainty. It would be very interesting to see how that played out. There was a high degree of uncertainty.
Yeah, he definitely delivered on that.
He delivered on that in spades. I think we might have mentioned on this podcast before, we did think there was a good chance that Israel and Iran, the US would try and take out Iran's nuclear facilities, given the clock was ticking on that. They did. And we thought there'd be maybe some moves towards a peace or ceasefire negotiation with Ukraine, but there may be some escalation ahead of that as the two sides sort of tried to, cement their positions. We spoke about China potentially using critical minerals as a bargaining chip, which we saw them do that. And then the whole theme around sort of decoupling and defence spending.
I was just going to say, just geopolitical tensions in general are sort of higher than they were 12 months ago, and they're not all emanating from the White House, but it's certainly been a catalyst.
Yeah, definitely. In terms of equity returns, once again, we were too conservative. We spoke last year about having 2 successive years of 20% plus kind of equity returns. We talked about there being 4 years of 20% plus equity returns leading up to the dot-com bubble. So we thought, oh no, that's not likely to happen. And sitting in based on the returns year to date to November for hedged global equities, it's sitting at around 18. Yeah. So it could potentially tip over the 20. Depends.
Very, very heavily led by US equities and technology in particular. Again,
yeah. So we were a bit too cautious. We said sort of high single digit, low double digits, so around that 10% level last year, driven by earnings, which proved to be broadly correct, but earnings were stronger than what we thought.
But it's interesting there. We've got a juxtaposition of the US economy, perhaps not quite as strong as expected, but the equity market still charging ahead, and there's probably a little element of the two-speed there of how well the AI economy and let's call it actually the AI share market as well is doing versus the rest of the pie. But one to be revisited in your key themes, no doubt. And maybe let's step through to those if we can. So in the first of your key themes for 2026 is the blending world of national security and industrial policy and economic outlook. And you touched on it before, but step that out a little further for us.
Yeah, I think it plays into this whole sort of global decoupling that we've seen, really accelerated by the Trump administration's America First policies, where it's very much more transactional, where global alliances don't matter anymore, where trade is potentially weaponized, where countries are having to think about supply chains, about reshoring, about reindustrialization that we've seen. In Australia, case in point, we've got that future made in Australia policy. We've seen bailouts of various metal smelters and things recently. So it plays into that whole theme where governments are having to really think about national security, and that could be, more spending on defence, but also economic security in terms of securing critical minerals, energy, having metal and manufacturing capabilities, either onshore,
or with a very trusted partner,
or friendshoring, or to neighbours that we can trust.
So if we take the COVID period, I think it caused a lot of countries to look at their supply chains and think, well, hold on a second, we've moved to this offshoring of everything, and perhaps we've gone way too far on that front. And we've seen a bit of a trend through the post-COVID era, but probably particularly led out of the US as countries get more thinking about what are critical industries, what are critical resources. Let's make sure that we've got our hands on some of them, or we've got to have them closer at hand than we've had over recent years, and building up with some barriers there again, without a doubt. And this is not I think a trend that's purely isolated to potentially this administration in the US. This probably is a broader trend we're seeing globally right now.
Yeah, I think so. I think COVID highlighted it, and that wasn't necessarily for geopolitical reasons. That was just an awareness that that everyone when there's scarcity, everyone sort of wants to keep stuff for their own citizens. So, yeah, it's really a shift away from that, what they call the Washington Consensus, which was all about globalization, about the lowest cost provider being the competitive advantage, and that obviously saw a lot of production move to China and cheaper countries. So that's definitely in reverse.
How do you think about this trend from an investment perspective?
Well, so putting your investing hat on, you think, okay, what are the industries that are potentially going to benefit from that? It's potentially old heavy industry. It's metals and mining. It's critical minerals. It's defense industries that have to be potentially created. So there's there are ramifications for different investment sectors, I guess.
That could play out over many years.
Over many years, definitely.
Now, it wouldn't be any 2026 outlook before we get to the big topic of AI, and it's a broad area, and there's different parts of the AI value chain. The absolute standout beneficiary over the last few years has obviously been NVIDIA, and they've been the chip supplier du jour to pretty much the entire industry. That position is maybe those sands are beginning to shift a little, but a couple of parts to this. I guess, how do you think about AI's rollout and adoption more broadly? In our respect, we're probably still quite early in that journey. But two, how you think about it as an investor. And obviously, you can't get away from the bubble talk around, just how hard some of these assets have run in terms of valuation, particularly potentially in the private markets with companies like ChatGPT.
Yeah, I do feel like it's a bit of a rerun. We did write about AI bubble theme last year, and we're writing about it again this year, and maybe we'll write about it again at the end of next year. So I think it's definitely an ongoing theme. AI is definitely here to stay. It's part of a long-term theme. So I write about the amount, really just the eye-watering amount of money that's being invested in data centers, in NVIDIA chips, in energy infrastructure to support these data centers. And where do the returns come from? And in the report, we really struggle to see where the returns come from. Working backwards, if you want an acceptable return on the $7 trillion that's forecast to be invested between now and 2030, it's very large revenues that need to be raised to support that. And where do they come from? Do they come from, new areas, or is it trying to soak up things like advertising or subscription services?
It's worth taking a second just to restate that, because we have talked about it on the podcast before, but you've got some businesses that are very clear sellers of cloud services. So very obvious, they build a data center where they can sell, their cloud services from having those infrastructure facilities available. You've got then some a touch removed, so that the Metas of this world, I should say in that first category, we probably have the Microsofts and the Alphabet. Then we have those a touch removed, such as Meta, whose core business is really advertising, and it's not clear how they turn their investment there into a revenue line, but they might just see it as an existential. And then you have organizations probably another notch down, like OpenAI, company behind ChatGPT, trading on, $500 billion type valuation with revenues that are certainly sub 20 billion today, and the path is just quite hard to figure out.
Yeah, it's hard to make the maths work, and so that's we get into that and we think, well, okay, maybe some of this money won't ultimately be spent. They're big plans, but I guess they can scale those back if the returns aren't there.
The revenue's not coming through.
And then we talk about maybe it's good that like the railroad boom in the 1800s, that where fortunes were made and lost, and there were lot of money spent and
parallel rails put down in certain scenarios.
Absolutely, but it was ultimately for the public at large, it was great. It actually boosted productivity, but the actual people that spent the money maybe never made any returns from that. But the public at large benefited from the improved productivity and faster GDP growth. So we talk about things like that. And I think, more recently there have been concerns about the circular financing, the vendor financing, where you get, NVIDIA putting money into OpenAI, who then, contracts with Microsoft to use their data centers, who then use a firm like CoreWeave, who are called a neo cloud, to rent their GPUs, because they don't have the capacity, who then go and buy
NVIDIA chips.
NVIDIA chips. So it's this whole circular thing where one person's investment is another person's revenue, and we question the.
There's been quite a few of those transactions over the last 3 months or so.
There's a lot. If you try and draw it, it looks like a cobweb, of interconnections between these big players. So thinking about that, and then thinking about also the increase in debt that we've seen in recent, in the last 6 months or so. So, a lot of these big companies like Apple and Meta and even NVIDIA, they've got a lot of cash and they've got not much debt, but that's starting to change. They just, to fund $7 trillion worth of investment over the next 5 years, they can't just rely on their cash flow and their excess cash. They're going to have to borrow money. So we delve into that and think about the risks that may come from that. Excellent. But I think the conclusion is, at the moment, we don't see bubbles in all areas of AI. To your comment about, for example, OpenAI with a $500 billion valuation, a $1.4 trillion expenditure CapEx plan, and just $13 billion of run rate revenue and $10 billion of losses this year. It's just hard to see how
there will certainly, we don't know who all the winners will be, but there will definitely be some losers in this process as well.
Absolutely. So we talk about that in the paper.
Excellent. A third key theme in your Outlook report is the blurring of lines between, if you want, gambling and investing. You talk about the gamification of investing.
Yeah, I think it's really interesting. It probably traces its roots back to COVID, when everyone was locked down. There was no horse races, there was no sporting events. So the gambling sort of almost switched to the financial markets. You might remember a few years back, GameStop was a company that provided video games through retail stores.
Basically a dying business.
Basically a dying business that went through the roof as people got on to the social media websites like Wall Street Bets, and everyone piled in on this, and it just became another form of gambling. And it's really...
It rose very quickly and it collapsed again.
But people have short memories, and over the last few years we've seen a lot of investing going into, these cryptocurrencies, these triple levered ETFs, and these are ETFs that invest in an index or a stock but give you 3 times the gains or 3 times the losses of the underlying asset. So they're very leveraged. We see more of these, what they call 0 day to expiry options, very short dated options that can give you huge gains or losses within the day. So really encouraging that day trading.
You can go to zero, or you can make a bunch of money on it.
And you find out in one day. So it's very much that short term gambling mentality. We've also seen stock exchanges like NASDAQ, New York Stock Exchange, and Chicago Board of Options Exchange, all put in sort of filings to try and get 24-hour, 5-day-a-week or 7-day-a-week trading. So round-the-clock trading. So you can trade at midnight. When you come home after going to the bar or something like that, put on a few bets. And then also more recently, we've seen these, what they call prediction markets or event contracts, which are basically
your poly markets
or Kalshis, where they pay you out. People can put bets on, basically, one way or the other, depending on
investment markets, on politics, on all sorts of things.
On the Fed cutting rates, on anything, on sporting events. So it's this fusion of sort of sporting events and gambling, and everything's in an app that gives you instant gratification.
And that's actually interesting when you talk about like that, because it bleeds into the media as well. When you think about the amount of times you'd listen to a podcast or read an article, and they might quote you what the poly market rate or expectation is on this, and suddenly it's just part of everyday life.
Yeah. But
we're not day traders, so. But how does it play through? I guess
we
aren't.
But it is interesting just sort of seeing the whole psychology around it, and people, particularly young men in particular, who are really into this sort of stuff. What their experience might be, and what it might mean for long-term investors. Does it make prices more volatile? Does it mean we have to be up at midnight looking at what's going on in markets?
Momentum's clearly been a big driver of markets in recent times. It probably adds to that.
Yeah,
or this is possibly an explanation of why momentum has been as strong as it has in recent years.
That's right. Momentum has been a huge thing, what we call the junk rally, meme stock rally this year, and we do have a chart in the report, showing that's been the winning strategy this year, and it's made it very difficult for active stock pickers that actually like to buy good quality companies that are profitable, that are well valued, because this gambling mentality actually rewards you for investing in the opposite of that, companies with no earnings that are highly volatile.
And as you said, for example, the GameStop example is a perfect one. They can run forward incredibly quickly, but then when the momentum dies, they drop like a stone, and who's left holding the stock are the people that bear the price of that.
And we do get clients asking us about Bitcoin and even gold more recently, which is displaying some of the similar sort of momentum to it. So I think it's just something to be aware of as a theme.
Yeah. No, it's an interesting one, and certainly an interesting read and a good pick for you. Japan, not necessarily always in vogue, but what, as one of your key factors into 2026, what's driving the renewed interest in Japanese equities?
Yeah, this is actually something that's been going for a couple of years now, since the Tokyo Stock Exchange brought in rules to try and get Japanese companies to really become less conservative. So for many years, Japanese management and boards were very conservative. They didn't want to pay out dividends. They held on to cash profits that they'd generated. Partly it's probably some sort of cultural thing, face saving.
It very much is cultural.
Yeah.
You think of the trends historically. U.S. companies, we're going to have a bad quarter, let's sack half the workforce and go again. But it's made them very lean and very productive and very responsive. Japan's culture is, I guess, a bit stereotypical, but quite the opposite. Job for life.
Yeah,
saving face. Nothing should be allowed to fail. Almost.
That's right, and they also have a lot of what they call these cross shareholdings, where company A will own shares in company B for no other reason except just to, protect the Japan Inc. From takeover by foreigners. So the Tokyo Stock Exchange a couple of years ago has really put pressure on them to unwind this mentality, to release a lot of this capital that had been built up on their balance sheets, to unwind these cross shareholdings,
to just be more commercial.
Yeah,
full stop.
And it's been great. Like Japan's stock market has been one of the best performers over the past couple of years, including year to date. It's done better than the US market, for example, as all this value is gradually getting unlocked. So we talk about that, how to potentially invest in that and participate with that. And we're seeing some of the private equity funds that we work with, finally they're being allowed into Japan to try and buy some of these cheap assets and help unlock value for these companies. But it's tricky, they're still, culture's slow to change.
Those changes will take time, but it is sort of a step for them, in probably the right direction in terms of their stock market, which it's not necessarily had the greatest of time for a decade or so.
Yeah.
And geopolitics, of course, factor number 5. What are the key trends or risks as we step into 2026, given just how much is going on?
Yeah, actually, there's nothing that really jumps out this year as a sort of a risk. I mean, obviously, some things can, like black swan events.
The unknown
unknowns. But when we look at things, we think about, some big ones like East Asia, the South China Sea, Taiwan. We think that's probably not something for the next year. That's more of a longer term theme. I mean, there are reports of the Chinese being ordered to modernize their military to be ready to take Taiwan in 2027. But I think they've still got a few more years before they're really ready to do that. And we know, China's trying to develop its own semiconductor industry, so it's not necessarily relying on Taiwanese chips, and the US is trying to do the same. And once they no longer need Taiwan,
It's going to be a
for
lot
chips,
less strategically sensitive.
Then I think
than
maybe
it is
the
right now.
US will say, you can have Taiwan. We don't need it anymore.
Might depend who's in the White House.
It will depend. May depend on who's in the White House, but that's, I think, a few years away. So we don't see that as a big risk in the next year, and slightly optimistic that maybe they can sort something out in Ukraine. Although, who knows? We're about to get to the 4th anniversary of that conflict. But so I think it's actually slightly better.
You talked to last year, I guess the fear there was that it did go into a broader conflict in the Middle East, particularly involving Iran, and that would have an impact on energy supplies.
Yeah, and that was briefly happened in the middle of the year, but has fallen away. So the Middle East, in some ways, looks a bit more stable. So I think it's not I mean, there's always risks there, of course, but it's not as great as probably it was 12 months ago.
Possibly a slight notch lower. And just to sort of pull this back together, and obviously I encourage everyone to read the report because that's where the granularity and the real value is. But high-level thoughts on asset classes, because you talked there about 2025, and we didn't think U.S. equities in particular could have a strong another 12 months. How do you read the outlook across, if I talked just high level, particularly equities and bonds and fixed income?
Well, I think from an equity perspective, we're still reasonably optimistic about equities. There's a lot of tailwinds, some of which we've described about lower interest rates, improving consumer spending. Potentially the US economy could get a growth jolt. Heading into the midterms, Trump's obviously keen to, and the Republicans are keen to, not lose the House, and for Trump to become a lame duck. So there is, some of the stimulus flowing from the one big beautiful bill, which could be supportive. So,
and that's a very important point, because we talked about how the Trump administration came out this year, and it was kind of tipped on its head. They came out with that more aggressive tariff policy, and then that sort of deregulation, tax cutty type stuff came later, all wrapped up in the world's most ridiculous big bill. But that probably hasn't really been felt necessarily by their economy yet.
No, that will start to play out in coming months as people get tax refunds and things like that. So I think there's a lot of tailwinds, and some of the tariff things will fade. I mean, there's even possibility that some of those tariffs get rolled back, or the Supreme Court deems them illegal, and then they have to pay refunds to people, which could juice the economy a bit as well. So net, we're reasonably positive. I said Europe's going reasonably well with all that defence spending. The broader themes about onshoring and reindustrialisation are positive. So we're positive, and we think it could be equity returns could be somewhere between 10 and 15%. Okay, so we're going to be a bit bolder this year, and
so it's slightly ahead of trend still.
And there's the AI infrastructure investment. So I think, and we know the most recent, like this year, earnings did grow about 15%. So assuming just equities track earnings, then you could have 10 to 15% return.
And how do you feel about fixed income with what we've spoken to previously on, I guess, where rates are at, that sort of spectre of inflation lingering there?
Yeah, we don't see, I think, like the rate cutting cycle, barring the US and Japan, which is still raising rates, and the US, which possibly has one or two more rates, or even more if we
subject to who the next
chair is. We think rates are broadly steady. There could be a little bit more steepening in the yield curve, so investors demand slightly higher yield on longer dated bonds, given questions about debt sustainability and things like that. But broadly, we think most of the returns for fixed income will come from income. So you're looking at a sort of 4 to 6% type return from fixed income in the year ahead, assuming no risk-off events or no spread blowout in credit spreads.
So you remain reasonably comfortable with allocations in both spaces. Excellent. And maybe we wrap by just what are the few things that might be keeping you up at night as we step into 2026 as an investor?
Yeah, so the key risks that we're kind of monitoring at the moment, obviously, AI bubble burst. I'm not sure what would cause that, but it could be a realization that, some of this investment is not justified based on the numbers. We've seen some wobbles with Broadcom and Oracle recently, so people are starting to question it. And if there was a proper unwind like the .com, then that could even feed back into the real economy as companies start to slow down their capex and data centers. And
everyone just becomes a bit more cautious.
So that's a key risk. On the positive side, if the US economy overheats, and inflation doesn't come down, so they get maybe a reacceleration of inflation, and then the Fed has to start hiking rates. That would clearly be bad for bonds and equities. So that's an upside, or sort of upside risk to growth, but downside risk for asset prices. A debt crisis. We've had some we take cockroaches.
I was going to say we take almost the whole private debt space with a degree of caution, but there has certainly been some potential canary in the coal mine type moments.
Yeah, and it's not just limited to private credit. That some of that happened in sub-investment grade credit, and we know from time to time investors even get worried about government bonds.
U.S. government debt
U.S.
levels.
government bonds, French government bonds, UK potentially.
Leave Liz Truss alone. She's been through enough. Yeah.
So there's that sort of general debt crisis umbrella.
I feel like some of those, particularly those government debt concerns, are going to flare up from time to time now, without a doubt, just with the level of debt loads.
We've seen them, almost without fail every 6 months in some part of the world. Loss of Fed independence. We sort of highlighted that when we discussed questions about who the next Fed chair might be, where their loyalties lie, whether it's to the independence of the Fed or to the Trump administration, who are very aggressively pushing for lower rates, because if you want to get re-elected, then bringing rates down might help you do that, even if it risks an inflation spike.
Well, if you want something that's going to spook the bond market, really inappropriate activity there could be just that.
Absolutely. And then I guess the other one is just, sort of on a related theme, some sort of inflation shock, if China stops supplying rare earths, or some oil shock or something like that.
Some other supply side constraint that really then ripples its way through the whole
system.
system.
They're sort of the key ones that we're looking at. And then there's the general one of geopolitics, and in particular sort of grey zone tactics. We've seen Russia sort of send some drones across Poland and sabotage some rail links, and it's just the increasing theme that we're seeing.
The evolution of modern warfare,
Yeah.
unfortunately. A wonderful fly across the top, I respect. You've done very well there, given the depth of what's in your report, to sort of give us a quick flavour, and I want to congratulate you on that, and
thank you.
encourage for any of our listeners that haven't had a chance yet to download and read that report, that they very much need to do so. But thank you once again, Nick, and special thank you to all our listeners. I want to wish you all a very happy Christmas, and hope to us all, hopefully a healthy and prosperous 2026 ahead. Take care, and we'll speak to you in the new year.